Welcome to The Explainer. Today, we're breaking down a really unique company in the precious metal space, Wheaton Precious Metals, ticker WPM. From an investor's perspective, it offers a totally fascinating twist on how you can get exposure to gold and silver.
Okay, so let's dive right in. We're going to follow 5 key questions that any investor should be asking. This will be our roadmap. We'll look at the business model, what the bulls love about it, the risks, how it stacks up against the competition, and we'll leave you with one final critical question you've got to answer.
So first things first, we've got to understand what Wheaton actually does, because it is not your typical mining company, not even close. It operates with a completely different playbook, and that really changes the whole risk and reward equation for an investor.
And this, right here, is the central puzzle that Wheaton's business model is built to solve. How do you get all the upside of rising metal prices without the massive headaches and costs of, digging giant holes in the ground, managing thousands of workers, or buying fleets of enormous trucks?
Well, the answer is this really clever financial tool called a streaming agreement. This is the engine that powers the entire business. See, Wheaton acts kind of like a specialized bank for miners. They give a mining company a huge chunk of cash up front, which the miner needs to build their project. In return, Wheaton gets the right to buy a piece of that mine's future gold or silver production for just pennies on the dollar, for the entire life of that mine.
Now, to make that a little more concrete, think of it like this. Wheaton isn't the farmer who has to worry about bad weather or broken tractors. Nope. Instead, they're the ones who prepaid the farmer for the right to buy, let's say, 10% of every single future harvest at a fixed price that never ever changes no matter what happens to the market price of the crop.
And this, right here, shows you the absolute magic of this model. By locking in that super low cost, in this case just $470 an ounce for gold, their profit margin just explodes as metal prices go up. Look at this. Recently that created a staggering cash margin of over $2,700 for every single ounce. It's incredible.
So for you, the investor, the crucial point is this huge difference in the risk profile. While a traditional miner is constantly fighting rising costs for fuel, for labor, for equipment, Wheaton is totally insulated from all that. Their cost is fixed, and that means their profits have this incredible amplified leverage when commodity prices go up, but with way more predictable costs.
All right, so let's move on to the bull case and see how all of this builds into a really powerful investment thesis. For Wheaton, it really comes down to 3 core pillars that all work together to create a pretty formidable company.
Pillar number 1 is this awesome, self-reinforcing system, a virtuous cycle that gives them a real competitive advantage. It starts with their portfolio of top-tier mines, which just gush cash. All that cash builds an incredibly strong fortress-like balance sheet, and that balance sheet gives them the firepower to go out and fund the biggest and best new mining projects. And guess what? Those new deals add more high-quality assets to the portfolio, which starts the whole beautiful cycle all over again.
And that brings us to pillar number 2, that fortress-like financial strength I just mentioned. Get this, as of mid-2025, Wheaton has 0 debt. That's right, 0. On top of that, it's sitting on over $1 billion in cash and has access to another $2.5 billion in credit. So that's over $3 billion in liquidity to grow the business without taking on debt or watering down shareholder value.
And all that financial power lets them be incredibly picky. They don't have to chase bad deals. They've built a portfolio where the vast majority of their production, we're talking 93%, comes from mines that are in the lowest half of the industry cost curve. These are the most resilient, most profitable mines on the planet, the ones that will keep printing money even if commodity prices take a hit.
And the third pillar is just how visible their growth is. This isn't some pie-in-the-sky speculation. Management is projecting a massive, roughly 40% increase in production by 2029. And the best part? For an investor, this growth is largely de-risked. It's coming from projects they already own that are already under construction or fully permitted and ready to go.
Okay, but let's be real. No investment is a sure thing. And now we have to do the responsible thing and look at the other side of the coin. An informed investor always understands the bear case. And for Wheaton, the risks are pretty clear and they are significant.
So the risks really fall into 4 main buckets. First, and this is the most obvious one, is commodity price risk. The business model gives you great leverage on the way up, but that sword cuts both ways. A drop in gold and silver prices will hit their bottom line hard.
Second is counterparty risk. Remember, Wheaton doesn't run the mines. They are completely dependent on their partners, big guys like Vale and Glencore, to operate those mines safely and efficiently. A strike, a flood, bad management, any problem at a partner's mine is a direct hit to Wheaton's cash flow. Third, geopolitical risk. Their assets are in 18 different countries, so they're exposed to sudden changes in tax laws or mining rules all over the world. And finally, asset concentration. Even though their portfolio is big, a huge chunk of their value is tied to just a few massive assets, like the world-class Salobo mine in Brazil. Any problem there would have a really outsized impact on the whole company.
So, with all that in our heads, the business, the strengths, the risks, how does Wheaton actually stack up against its direct competition in the streaming space? Let's do a quick side-by-side. This peer comparison is really telling. First, just look at production, which we measure in GEOs. That's just gold equivalent ounces, a way to standardize all the different metals. WPM is the clear leader in terms of sheer volume. But the key difference, for an investor, is in the business mix. Wheaton is a pure play, 98% of its business is precious metals. Its biggest rival, Franco-Nevada, is way more diversified with a big and growing energy business on the side. So the choice for you is pretty clear. WPM is a focused, leveraged bet on gold and silver, while FNV gives you much broader exposure to different commodities.
All right, let's pull all this together. We've seen the powerful business model, the strong bull case, the very real risks, and how they fit into the competitive landscape. Now we can frame that final critical question that you have to answer for yourself before even thinking about an investment.
At the end of the day, the whole analysis really boils down to this single, crucial trade-off. On one side of the scale, you have these exceptional fundamental strengths, the business model, the balance sheet, the visible growth. But on the other side, you have that unavoidable exposure to volatile metal prices and the simple fact that a high-quality company like this often trades at a premium price.
And that's the essential question this explainer leaves you with. It's all about that balance of risk and reward. Is the incredible quality of this business enough for you to justify the risks that just come with the territory? Answering that question for your own portfolio and your own outlook on precious metals, well, that's the key to making an informed decision.